For most of us out there, owning a home can be a really good investment over time, but how much house can you really afford? Just because you can afford the monthly payment and it might feel like it fits into your budget doesn't actually mean that you can afford that house, because there's a lot of different expenses out there that we don't add up when it comes to a mortgage, and those expenses need to be tracked as well. So in this video, I'll go over all my rules for home affordability, and they should be very easy to follow along with. And then you can make your own judgment call as to what advice you actually want to take and what advice you don't want to take. Now, traditionally, if you want to know how much house you can afford, the general advice is that your mortgage should never exceed 28 to 31% of your monthly gross take-home pay, and that's the general advice out there. So if you happen to make $60,000 a year, then that means you're going to be bringing in $5,000 a month. And 28% of $5,000 ends up being $1,400 that you can spend on a monthly mortgage payment. And that's at the 28% level. Like I said, you can go up to 31%. And that's what everybody else says for how much home you can afford. And then it's also advised that all of your combined debt, including the mortgage, doesn't exceed 45% of your gross monthly income if you want to get approved for a loan. Now, in my opinion, I feel like this advice leads way too many people into buying too much house, and most of them are probably going to end up house poor, because in reality, there's a lot of other expenses that go into owning a home, and these expenses need to be factored in as far as how much home you can actually afford. Because in reality, you're not just going to have your mortgage payment, you're also going to have the added expenses as well. And we're talking utilities, property taxes, insurance, maybe HOA, and even PMI, which stands for private mortgage insurance. And this is going to happen if you don't put at least 20% down on your home. So you have to factor in all the associated costs. And some people even like to factor in maintenance. So just keep in mind that you have to factor in everything and put those on top of your mortgage in order to find out if you can afford the home or not, because those are real expenses when it comes to being a homeowner. And at this point in the video, if it is making sense to you, can you please just give it a big thumbs up, because that'll help this video out tremendously, and I can tell if you guys are liking it or not. Thank you very much. Now, I do understand that the cost of living is extremely high in different areas, because you have to be honest with yourself here. If you're going to live in New York City, it's going to cost a lot more to live there than it does in Houston, even if you have the same job. And also in those higher cost of living areas, the home price, the median price, is also going to be a lot higher. And I understand that the housing market across the entire country is going up. But overall, if you guys follow my rules, I think for the majority of us, you probably can find this a good way to know if you can afford a home or not. The first thing you should know is that I am fine with a 30-year fixed mortgage, especially with today's interest rates, but I do want you to be putting at least 20% down on the home in order to avoid paying private mortgage insurance. So that being said, if you take on a 30-year mortgage and you put at least 20% down, then in my opinion, I believe that your mortgage and all of the associated costs, so we're talking the HOA, the insurance, the property taxes, everything that's associated with your home, should not exceed 30% of your net take-home pay, because that is the money that you actually receive, and we're talking the money that's after taxes. So if you happen to bring home $7,000 a month after taxes, then 30% of $7,000 is going to leave you with $2,100 that you can spend on your mortgage and all the associated costs. And this is also assuming that you're doing a 30-year fixed mortgage with 20% down. And obviously, if you can afford a 15-year or a 20-year mortgage, then that's going to be in your best interest, because you are going to save more money in interest. But I understand that because the housing costs are so high right now, most of us can really only get into a 30-year mortgage unless you're saving up for a very long time, or you sell a home and you get into another home with all of that equity. Now, if you happen to have a lot of debt, this also has to be factored into the equation on how much house you can afford. Because honestly, I believe that if you have more than 10% in monthly debt payments as far as your net income goes, then this is really pushing it as far as your home affordability, because you've already got 30% going on your home and then 10% right here for your debt. So honestly, if you can't get that below 40%, then you probably can't afford that home, even if the interest rates are low, it's a 30-year mortgage, and you have a really good down payment. So if you do have a lot of monthly debt obligations and they add up to more than 10% of your net take-home pay, then I would probably pay some of those off before you consider getting a mortgage, just to make your home more affordable. Now, if you already own a home and you're in this predicament, then I would really focus on paying off some of those debts, because I don't want you to be house poor. So overall, if you want to follow all of my rules for home affordability, then you're going to start with a 30-year mortgage, you're going to put 20% down, and then your mortgage and all of the associated costs do not exceed 30% of your net take-home pay, and then all of your monthly debt payments do not exceed 10% of your monthly take-home pay, making it a total of 40%, and this is the maximum that I would feel comfortable with as far as home affordability goes. Because you're always going to need enough money left over for life and savings and emergencies and all sorts of things. So you just have to make sure that you be realistic with the home that you're living in or the home that you want to be buying, because overall life happens and you have to have enough of a buffer so that you're not house poor and getting into a really bad situation just because you have too much house. Now, if you just happen to find this channel, I'm Jason with Honest Finance, and I make a lot of videos on different topics that'll give your life and your finances more value. So if you do have an interest in this type of content, feel free to subscribe. But thanks for watching this video. Have a great day.